Hello, ladies and gentlemen. Have a good day. My name is Nguyen-BABAIU23182. This is my presentation video for the course e-commerce taught by lecturer Nguyen at International University Vietnam National University. Today, I will present a case study mobile payments, Fintech versus the bank giants. We explore how mobile payments have evolved, who the major players are, and what challenges and opportunities exist in this fast-changing market. I divide my presentation into three main parts, which is case summary, 4 questions from the case, and conclusions. Let's begin with the case summary. The mobile payments market had become a battlefield among fintech startups. Tech giants like Apple and Google, large retailers such as Walmart and Starbucks, and traditional banks. Each group wants to control how consumers make payments. There are three main types of mobile payments. First, universal proximity systems such as Apple Pay, which use NFC and work at many merchants. Second, branded systems like Walmart Pay or the Starbucks apps, which only work at one retailer but include loyalty rewards. Third, peer-to-peer systems like Venmo and Zelle, which let people send money directly to one another. Generational differences are clear. Millennials and Gen Z lead adoptions because they are comfortable with smartphones, while older generations remain cautious and prefer traditional cards. Two examples illustrate this trend. Venmo, popular among young users and now owned by PayPal, is evolving into a super app. And Zelle, backed by major US banks, has grown even faster thanks to instant transfer and building trust. Overall, mobile payments are growing, but challenges remain. Market adoption is low, many consumers are confused by the options, and security concerns persist. The future will depend on who can best combine innovations, convenience, and trust. And that's the end of the summary. Now we will move into the question part. First question, what are the three types of mobile payments and how do they differ? There are three types of mobile payments apps described in the case study. First, universal proximity payment systems like Apple Pay, Google Pay, and Samsung Pay. These work at many different merchants and that have NFC terminals. They are convenient because one app can be used almost anywhere. Second, branded proximity payment systems such as Walmart Pay or the Starbucks apps. These only work at one retailer's stores, but they usually give extra benefits like loyalty points, discounts, or promotions. Third, peer-to-peer payment systems like Venmo, Zelle, or Square Cash. These allow people to send money directly to friends or family using a phone number or email instead of paying at a store. In short, universal apps can be used at many merchants. Branded apps are limited to one retailer with loyalty features, and P2P apps are mainly for sending money between individuals. Second question, which age groups are the most likely to adopt mobile payments apps and why? The age groups most likely to adopt mobile payments apps are Generation G and younger millennials. For example, a study by the Federal Reserve Bank of Atlanta found that 93% of Gen Z consumers under 25 using a mobile payment app in the past year. In comparison, only about 50% of baby boomers over 65 had done the same. Even after adjusting for income and education, younger people are still about 30 percentage points more likely to use mobile payments than older generations. Another study published in IJFMR highlights that over 90% of Gen Z youth download and use mobile payment apps. This is because smartphones are central to their daily lives, not only for shopping but also for entertainment, communication, and money management. In short, Gen Z and millennials lead adoptions because they are digital natives. They rely on smartphones for everyday activities, and they value the speed and convenience that mobile payments offer. In contrast, older generations remain more cautious and prefer traditional credit or debit card. Third question. Why have fintech startups had a hard time competing with the tech giants? Fintech startups face serious challenges when competing with tech giants in the mobile payments market. First, big tech companies like Apple, Google, and Samsung have a huge advantage because they control the hardware and software ecosystem of smartphones. Their payments apps come pre-installed and integrate seamlessly, giving them immediate scale. Second, large firms such as PayPal and Square already have massive user bases and brand trust, which small startups cannot easily match. Startups often struggle to get merchants and consumers to adopt their platforms. Third, fintech startups face industry-specific challenges. Regulations and compliance. They must constantly meet strict rules like KYC and AML, which demand resources they often lack. The second challenge is data security and privacy. Handling sensitive financial data makes them prime cyber attack targets, and building strong defenses is expensive. Third challenge is customer acquisition. Competing for attention in a crowded market is costly, and many startups fail to scale their user base. The fourth challenge is partnership barriers. They often need cooperations with banks and established institutions, which can be hard to secure. Because of these disadvantages, many fintech startups either fail to grow or get acquired by larger companies. Venmo is a good example. It started strong but was bought by people to survive in the competitive market. And the last question, what is Zelle, and why has it grown so quickly in the last few years? Zelle is a U.S. digital payment service originally created in 2011 as clear exchange by major banks like JP Chase, Wells Fargo, and Bank of America. In 2017, it was rebranded and launched as Zelle, operated by Early Warning Services, a company owned by 7 leading U.S. banks. Zelle lets people send money directly between banks' accounts using only a phone number or email. Unlike Venmo or PayPal, Zelle does not hold funds in a separate wallet. The money moves instantly from one bank account to another. Now, why has Zelle grown so quickly? This is because for several reasons. First is trusted ownership. It is backed by the largest U.S. banks, so people already trust it for security and reliability. The second is integration. Zelle is built into the mobile apps of over 10,000 financial institutions, so users don't need to download a new app or sign up for a separate service. The third is speed. Payments are nearly instantaneous, while services like Venmo often take at least a day unless users pay extra for instant transfer. They have no extra cost. Transfers are free when using existing bank accounts. Another reason is large customer base. Because so many banks already offer Zelle, adoption spread quickly through network effects. And as a result, by 2022, Zelle has around 62 million US users and processed more than $365 billion in payments, which is far ahead of Venmo's $210 billion in the same year. In conclusion, the case mobile payments, fintechs versus the bank giants shows how technology, finance, and consumer behavior are reshaping the way we pay. Fintech startups drive innovation. Tech giants use their platforms to scale. Retailers build loyalty, and banks respond with services like Zelle to maintain trust. Millennials and Gen Z are leading adoption, while older generations prefer traditional cars. However, challenges remain, such as slow market adoption, consumer confusion, and security concerns. Ultimately, the future of mobile payments depends on which players can balance innovation, convenience, and trust. Mobile payments are not just a trend, but a key part of evolving financial landscape. And here are some of my references. And that's the end of my presentation video. If you have any questions, please don't hesitate to contact me via this email. Thank you for listening.